Hey everybody, this is Jose Blasco here. How are you, my friends? We're about to start the session in around 20 seconds. It would be good just as a sound check if you were to type a quick hello in the comment box. That would be my clue, so I know you heard me and therefore sound is okay. Okay, we're about to start and that way we can start on time. Perfect. Very good, everybody. Wonderful. I can see your hellos. That's perfect. Welcome to the session, everybody. Welcome to the Saturday, in this case, session. We are getting together today for sharpening purposes. So today we're going to be talking about the markets, more specifically the Forex markets. We'll talk about the currencies. And it's going to be a pretty important session because, as I said, I believe once or twice in prior sessions, even if you don't trade currencies, in the end, whatever product is traded when we trade the price of a product, and that particular price is always priced in a currency. For example, if you buy a stock, let's say Microsoft, and you paid 110, it's $110, which happens to be a currency. Okay, so many times when people think about Forex trading, they think about a market to trade and speculate with, which certainly it's amazing for that purpose. But at the same time, there are other consequences and correlations and impacts coming from the Forex market that apply to all other markets out there. Okay, so today, it's a pretty important session, and that's why I started today by stating it's an important day, okay? But anyway, let's begin officially here. Today it's 25 of May of 2019. Jose Blasco is my name. I'll be your guide. Again, repeating myself very quickly here, we are sharpening today. Today we are getting together for sharpening purposes. Forex is going to be the key subject for the day. And before we start, disclaimer, let's do it. The following videos and clips and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Great, so we're gonna close the window, get our TradeStation ready. Apart from TradeStation, we also have TradingView. So we have the UFOs running on TradingView, the UFOs running on TradeStation, okay? And again, before we start getting into charts and everything, we need to talk about Forex, okay? The chart I have, as you can see on the upper left, is the Euro US dollar, which is obviously a currency. But again, I would like to have a little bit of a formal beginning of the session where I first answer a key question, which is what's Forex? Okay, what is Forex and how does it work? Because I mean, probably everybody here in the group, if I say Forex, probably in the back of your mind you are thinking foreign exchange currencies, which is what it means. But at the same time, there are multiple implications when you think about trading the currencies or understanding the currency markets that are not necessarily understood in your first thought when you simply take that acronym Forex and just translate it into foreign exchange. Okay, so there are multiple things that we need to discuss before we get into the charts. Okay, and I am aware that some of you in the group trade Forex in present times. Okay, so some of the things that I will say, especially at the beginning of the session, will be quite basic. Okay. Always good to go back to the basic and have a little bit of a review, okay? But very quickly, as you will see, we're gonna get quite advanced, okay? So first of all, Forex. What is Forex? Well, Forex is an acronym that represents foreign exchange, okay? That's what the meaning of the acronym is, okay? And foreign means that you're gonna do exchange of something that belongs to other countries, and that thing is currencies, okay? So another way to say Forex is to talk about currency trading or currencies, okay? And the short version on how Forex is normally expressed is as FX, okay? Now, that term, especially since a few years ago, is now commonly used including the cryptocurrencies, which is another type of currency, which at some point in the future we'll have to talk about those cryptocurrencies specifically, because there are many things to be discussed about cryptocurrencies. On top of that, it's a market that does not benefit from regulation. and therefore different exchanges, different brokers, different countries, different places, different coins could represent a totally different instrument to trade. Where with FX or Forex, we're going to be talking about the trading of the currencies that are regulated by governments, not typically central banks, okay? And as an example, I'll mention the Fed, the Federal Reserve in America, the BE, the Bank of England, for example, the ECB, the European Central Bank, the BOJ, Bank of Japan, and more, okay? So those central banks are normally the ones that control those currencies. In other words, when we talk about Forex, even though we could certainly add the cryptocurrencies, in today's presentation, in today's lesson, we will be talking about the currencies that are not crypto, meaning the currencies that are controlled by central governments, central banks, and that benefit from regulation, okay? And we'll need to talk about regulation as well, because there are many things to be said about the currencies, okay? And by the way, obviously, as we start the day, as you know, it's a sharpening day, so, I'll probably do a lot of talking, right? Because it's a lesson, if you wish, it's a lesson day. But feel free at any time, if you have any comment, you want to add something to what I said, or you have any question, please feel free to interact with me using the comments box, okay? And that way, I can catch on the fly your questions, and if it's the right time, give you an answer. And if the answer is coming later, then let me be the one to tell you, okay? But don't stop yourself from asking questions if anything comes to your mind, okay? Anyway, so then we're talking about currencies, okay? And now we can certainly make a very long list of currencies, okay? There are many currencies in the world, okay? But does that mean that we're gonna trade them all? No, absolutely not. We're gonna trade the currencies that are the most liquid, just like when we trade stocks, for example. If you trade stocks in the US, you got close to anywhere between 8,000 to 9,000 stocks in the US market. Do we trade them all? No, absolutely not. Maybe we are trading, a collection of maybe 25, 30, 50 stocks at the most, I would say. Why? Because we normally focus on the most liquid markets, the highest quality products. Same in futures, if you are a trader of futures, okay, do you trade them all? Okay, no, you don't trade them all. Maybe you focus on the crude oil, the S&P. Could you trade orange juice futures? Yes, you could trade orange juice futures. You could certainly do that, but it's not a very liquid market, funnily enough. That's a very bad joke, by the way. But you could trade it, right? So the possibility is there, right? So in spot Forex, you can do the same thing. You could trade the Thai baht, for example, the currency of Thailand. You could certainly do that, but as an active trader, normally you would not do it. Why? Because that currency, it's not as liquid as, for example, the euro or the US dollar, or maybe the Australian dollar is also very liquid, right? So even though there are many currencies, okay, the currencies that you will normally deal with is, I'll start with the euro, the US dollar. I'll continue with the Great British Pound and the Swiss franc. Okay, and all of this is US and European zone. I missed the Canadian dollar, that also is in North America. If we move a little more in the Asian region, then we have the Japanese yen, the Australian dollar, and the Kiwi, the New Zealand dollar, and also the Singapore dollar. Okay, so do we have more currencies? Yes, we do have more currencies. Okay, you may be talking about other currencies such as the Mexican peso. You may be talking about currencies such as the Malaysian ringgit. You may be talking about currencies as, many more. But again, this is, and I'll talk more about that in a minute, but this is what we normally call the exotics. And by exotics, okay, basically what we mean is currencies that are not too traded, and therefore, again, we are lacking liquidity. So you may have this amazing opportunity when you look at the chart, but then when it comes to executing the trade, you may be really hurt on slippage. So again, when trading Forex, when trading currencies, what we normally do is to focus on the most liquid currencies, which basically are the euro, the US dollar, the pound, the Swiss franc, Canadian dollar, Japanese yen. Okay, so we are talking about 6, 7, 8, and 9 currencies total. Those are probably the most liquid currencies in the world right now. But there is something very important as well to understand, okay, which is when you trade Forex. Okay, and I see a couple of questions there. I'll be there Yeah, Bojan, I know it was a very bad joke. I'll be there looking at your questions in just a minute, okay? But there is also something very important for us to keep in mind, which is when we trade when we trade currencies, we don't trade currencies themselves. What we actually trade is pairs of currencies, okay? Pairs, okay? So the term that we use is the term currency pairs, okay? That's how we call it, okay? So currency pairs. And a currency pair means that we combine two currencies at a time. Okay, that's what a currency pair is a pair of two. Okay, the name is kind of self-explanatory, but just in case, you know, a pair is two. Okay, and why is it that we combine two currencies? Well, because we want to benefit from price movement, right? So let's say you have collected $50 and you keep $50 in a drawer, or you have collected, you know, 50 Japanese yen. I mean, that's very little. You know, whatever currency, 50 of whatever currency, and you put that currency in a drawer, and you come back 10 years later. Well, you still got 50. The price has not changed. Why? Because it's that currency. So how can you make money with the currencies if a currency is a currency, right? And the price of the currency doesn't change because the currency defines itself because it's the currency, right? So how can you speculate and make a profit trading the currencies? That's why you need to combine them into two. It's what we call currency pairs, okay? So for example, if I was to take the euro combined with the US dollar, okay? And this, you know, normally we call it the euro. When you say, yeah, I trade the euro. Okay, well, no, you don't trade the euro. You trade the euro against the US dollar. We just call it the euro because it's short. Okay, and it's easy to say and it's easy to remember. But really what you are trading is a currency pair made of the euro and the US dollar. It could also be the euro with the Japanese yen. It could also be the euro with the Canadian dollar. So you could create combinations as you wish, creating multiple types of pairs, and every one of those pairs will be traded. Okay, and that's how you make a profit. Why? Because depending, I mean, the price movement in any and all markets, no matter if we are talking about real estate or the price of diamonds or the price of you know, a collection of stamps, or, you know, it doesn't matter what we are talking about. The price of things is determined by the supply and the demand of those things. Okay, how many people are willing to buy, how many people are willing to sell, and how desperate are they to buy or to sell. That sets the prices for things. For let's say, for example, that now in the Eurozone, you know, the economy is very good, or maybe the European Central Bank starts raising the interest rates that euro bonds pay. So that may create a lot of willingness to buy euro. And let's say this happens at the same time where in the US dollar zone, they do the opposite. They reduce the interest rates, the economy is not too good. So what would happen? You would see many people selling the dollar to exchange it and purchase euro in exchange for the dollar sold. In other words, you have an imbalance. You have money coming out of the dollar, bringing the dollar down, and that money is coming into the euro, strengthening the euro. So what would happen? Well, the exchange rate between the euro and the US dollar, okay, would move up. Why? Because you have an intense amount of purchasing in the euro and an intense amount of selling in the dollar, okay? And that would create an imbalance, and next thing you know, price moves, okay? In other words, for example, the chart I have, okay, even though I haven't explained charts yet, but the chart I have, it's pointing at 1.12039, okay? To simplify it, let's call it 1.12, okay? Let's simplify it and say it's 1.12. Well, if the euro US dollar exchange rate is 1.12, okay, and if I want to be precise, 0.39, okay, if that's the exchange rate, what does that mean? Well, it means that to purchase 1 euro, I need 1.12 US dollars, okay? To purchase 1 euro, I need to sell 1.12 US dollars. In other words, what the charts in Forex give us is the exchange rate between currencies. That's what the value is. And when we trade Forex, and we often say, I trade currencies. Well, no, you don't trade currencies. What you trade is the exchange rate between two currencies that belong to a pair. Okay, that's what you trade. And that currency exchange rate, as you can see, goes up, okay, and goes down, and goes up, and goes down. And it's all because of the, as I said before, the intense buying and the intense selling that takes place. And of course, buying is buy orders, selling is sell orders, okay? And price begins and price ends where the orders are there waiting to get filled, still in a non-filled state, okay? So in other words, we're gonna be using our UFOs, okay, to do the Forex trading like we do with all markets, okay? But the difference is that instead of dealing with something tangible, such as crude oil, if you trade crude oil futures, or dealing with something less tangible, but still, kind of at least legally represented with a document, okay? Maybe we're talking about shares of stock, okay? So the value of shares of stocks, they go up and down, and we can use the UFOs to trade them too, okay? It's less tangible maybe than gold or crude oil, but it's still, somehow tangible. But what about the currency exchange rate? I mean, it's not like you are dealing with the currency, you are dealing with the exchange rate, okay? Well, you know what? It's also somehow tangible because we are dealing with currencies that are regulated, that are controlled by their central banks, where every transaction is supposed to be, audited by the banks who process the exchange, etc., etc. And therefore, obviously, this market is going to be, let's call it less tangible compared to the stock market, in the sense that you are now exposed, when you do trading of the currencies, you are exposed to the liquidity in the world. Maybe you buy euros from Canada, and the person who sold you the euros is from Japan, right? Where when you trade stocks in New York, for example, in the New York Stock Exchange, all the transactions happen in New York, in Wall Street. When you trade futures in the Chicago Mercantile Exchange, all the transactions happen inside that exchange in the city of Chicago. Where when you do exchange of currencies as a trader, when you do Forex trading, you may get that currency from anywhere in the world. You may sell that currency to anywhere in the world because currency is currency. Okay, so that's why I use the term less tangible, even though it's partially incorrect to phrase it this way, because obviously it's something real, okay? And you will understand better later when we talk about swap rates and things like that. You will understand better why is it real, because actually there is a process when we trade spot Forex for you to avoid having to take physical delivery of the currency you bought or you sold. There is something called the swap rates, and brokers take care of that. And I'll talk more about that, meaning that if the brokers were not to take care of this process with the swap rates, and you were to place an order with a broker to buy euro in exchange for selling euro, you would actually get physical delivery of the currency. So you are definitely trading something real, okay? But within being something real is much less control from a regulatory point of view compared to, let's say, stocks or futures or options, because that would be a centralized product that trade in an exchange, okay? So, and this will have multiple implications later when we get deeper into planning trades and placing stops and things like that. You will see how there are multiple implications, okay? We'll talk about that in a minute, okay? But let me take your questions before we keep going. So Orlando is talking about the difference between currency futures and spot Forex. So I plan to talk about it, Orlando, but if that's okay, I'll answer that question later, because I still need to explain a few more things about Forex in general to be able to understand the differences. Andrea, do you trade futures currency in the same time frame as Forex? The answer is no. And you will see why not later as well. Actually, it has a lot to do with the swap rates and the fact that currency futures is centralized because it's futures, where spot Forex, it's not centralized. So good questions. I'll get more specific with the answers a little later in today's session, because I still need to explain a few more things. Andrea, I tend to trade futures, including currency, intraday, while Forex in weekly trading. And that makes a lot of sense, Andrea. And we'll talk about why as well, okay? Even though there will be some disadvantages of doing that, so we also need to understand those disadvantages and also how to fix them, because actually we can fix them. So anyway, so coming back to where we are, then what we said is that when we trade Forex, we trade pairs. Okay, so we combine those currencies two at a time. And basically the first portion of the currency pair, in this case, the euro, okay, is what we call, it's, oh, can you believe it? I just got a blank spot in my mind. Oh my God. Well, it'll come back later. No worries. There are just two names to represent the first portion of the currency pair and the second portion, which I was going to share with you out of curiosity. We never use that as traders, but out of curiosity. So the euro is the base currency, and oh, that's it. It came back to my mind. And the US dollar is the quote currency, okay? So base currency and quote currency. And the reason why we call the second the quote, it's because you are basically quoting euros in US dollars. In other words, if the exchange rate is 1.12, you could say, okay, I am quoting euros in US dollars in a way where every euro is worth 1.12 US dollars. Okay, so just a little bit of terminology. To be honest, as a trader, it doesn't matter. If you are curious, then yes. So, you know, watch the recording again, play and pause and rewind. And make a note for yourself, you know, the base currency and the quote currency, okay? But what really matters is that you understand that by creating a pair of currencies, now you end up with this exchange rate, and this is what we trade, okay? So just out of a few examples, you can see here I got the euro, okay? So let me look at the euro here, for example. So if I look at the euro, notice how it's 112.03. So what does that mean? That for me to purchase 1 euro, I will need to sell 1.12 US dollars, because the US dollar in the second portion, right? If instead of the euro, I was to look at the US dollar Swiss franc, for example, CHF is for the Swiss franc. So then it would be 10015. What does that mean? It means that to purchase 1 US dollar, you will need 10015 Swiss francs. Okay. So notice how in the case of the euro, the US dollar is in the quote, where in the case of the Swiss franc, the US dollar is in the base. Okay, so who decided that? Why did they do it backwards? And why is this? Because this is confusing. Well, we need to blame ISO. Okay, ISO is an international organization. It's actually International Standardization Organization, and they have regulated, or I should say, they have defined and standardized how we name the pairs. Okay, how we name the pairs in the spot forex market, which, by the way, would be different later when we talk about futures. Okay. So in the spot forex market, you know, that's how it is. So the euro, which remember the euro is the friendly name for euro US dollar. Okay, we normally say euro, but it has the US dollar. So the euro USD has the euro in front, the US dollar in the second position. The pound, the Great British pound, okay, which we also call the cable. So the cable has the pound on the left, the US dollar on the right. Okay, so the base and the quote. The Aussie dollar, known as the Aussie, it has the Australian dollar on the left, the US dollar on the right. The New Zealand dollar, known as the Kiwi, has the New Zealand dollar on the base, the US dollar on the quote. The US dollar Canadian dollar, known as the Loonie, has the US dollar in the base and the Canadian dollar in the quote. So that one is kind of reversed, like the Swissy or Swiss franc, or the yen, okay, or the US dollar Japanese yen, okay. So, you know, some people will call the yen also the ninja, okay? Normally we call it the yen. So those are, to be honest, those are the most important currencies of all the currencies, okay? And notice I skipped the Singapore dollar here in this first list of currency pairs. So let me write it down. So euro, USD, Great British pound, USD, Aussie, USD, Kiwi, USD, USD Swiss franc, USD CAD, and then we also have the USD yen, USD Japanese yen. So this is 1, 2, 3, 4, 5, 6, and 7 currencies. And guess what? Those 7 currencies got a name. They are known as the majors. We got 7 majors. What does majors means? Majors means that you have the US dollar in the quote. Okay, you have the US dollar in the quote, okay, and they are the most important currencies in the world, because you could argue and say, okay, wait a minute, okay, what about the US dollar Malaysian ringgit? Okay, well, guess what? The Malaysian ringgit is not a liquid currency. So even though it has the US dollar, and based on that definition, it could be a major, well, it's not known as the major because that one is not liquid. Okay, so we are talking about all those currencies I got in my prior list, with the exception of the Sing dollar, even though the Sing dollar is quite liquid as well. Those currencies, okay, which are 8, correct? You combine them with the US dollar, you end up with 7 combinations, and we call that the majors, okay? Which are the most liquid currency pairs in the world. But then we also have the cross pairs, okay? So what is a cross pair? Okay, cross pairs. A cross pair is when there is no USD, okay? So no USD. If there is no US dollar, we call it cross pairs. For example, okay, euro yen, that's a cross pair. For example, Canadian dollar Swiss franc, that's a cross pair. For example, you name it, Aussie CAD, that's a cross pair, okay? No US dollar. And finally, we have the exotics, okay? And the exotics are anything else, okay? Which normally is not gonna be liquid, where, you know, you may have, you know, maybe sometime, you know, once every 2 years is worth it to take one of those trades in a very large time frame, such as the monthly or the weekly time frame. You have, you know, you get hurt on slippage, but because it's a long-term move, maybe you are shooting to catch, let's say 1,000 pips or something like that. So then, you know, maybe it's worth it, but it's really rare. Okay, it's really rare that you trade exotics. You know, normally we don't as traders. Okay, that would be only normally if you have an interest on a currency, because maybe you belong to a country where the currency is exotic, and you do want to have some position because, you know, you want to maybe, let's say you live, I don't know, in Hong Kong, for example, and you are invested in the Hong Kong market. You own shares in Hong Kong. And now you are concerned that even though the Hong Kong market is going to go up, maybe the Hong Kong dollar is going to go down. Meaning that you will have more money, you will have more Hong Kong dollars, but the value per dollar will be less because the exchange rate will be hurt. So then maybe you can have an offsetting, a hedging trade with a Hong Kong dollar, and you just do it because you live there. The Hong Kong dollar, by the way, is not too bad when it comes to liquidity, but it's certainly not too exciting. And also when it comes to volatility and price movement, is very boring. Okay, it doesn't move much. Some of you may be thinking, what about the Chinese yuan, right? Because this is the biggest economy in the world, isn't it? It's not there, okay? And the reason why is because of regulation, okay? Even though it's a big currency and potentially there may be lots of opportunities, the fact is that not all brokers provide yuan. Typically, yuan is limited in the price range. With many countries, they have government agreements where the exchange rate is pegged. That means that it's fixed, okay? There are many places like that. I'm just thinking, for example, as well, like United Arab Emirates, for example. They have a currency called the dirham. Amazing currency, amazing economy, amazing many things, but that currency doesn't move. It's always the same exchange rate against the dollar. And the reason why is because there is agreements between governments, right? So again, as traders, we need price movement, okay? And these are the most important currencies in the world as we speak, okay? And these things could change in the future, okay? Because, like, for example, before 2002, there was no euro, okay? So maybe you would be trading, you know, the German currency, the French franc, right? And but now is the euro. So these things may change, okay? And therefore, by the way, that makes news to be quite relevant for currency traders. Normally, when central banks change interest rates or intervene in the currency markets, normally this creates a lot of opportunity for us, you know, to enter the market. Not because of the news, of course not, but just using the news as a catalyst for whatever was going to happen faster. And we use the UFOs to enter and exit precisely. So, you know, that's what we do, okay? But anyway, so how are we doing? Looking at the comments. Yes. Thank you so much, Maka, for that. I just got kind of like blocked for whatever reason. Anyway, so let's continue, okay? Because up to this point, this is very introductory, and I believe that maybe even if you never traded Forex before, maybe some of those things you already knew it, okay? Because this is quite basic, but it's important because, like all markets, we need to speak the proper language. It's like if we trade options, okay, and you don't know what's in the money, at the money, out of the money, then we have a problem because we cannot give you instructions on when it comes to how to trade options, just because we are lacking on the terminology or vocabulary, okay? So here is a little bit of the same thing. So as we begin Forex, okay, we need to talk about terminology, okay? So talking about terminology, there is another thing that we need to talk about, which is the units to measure price movement. Because, think about it. No worries, Brian. Take care, my friend. Think about this for a minute, okay? Let's say, for example, the euro currently is trading at 112, isn't it? So let's say that 2 weeks from now, the euro is going to be trading at 2 instead of 1.12. Let's say that was the case. What would that mean? What would the implication be? That would be crazy. That would mean that suddenly the euro became twice as strong compared to the US dollar. In other words, everything you buy from Europe using US currency would be double the price, or everything you sell, from the US to Europe is half the price, In other words, currencies cannot move fast. You cannot have a currency move from 1 to 2 or things like that. It could happen, but it's going to take years, And again, central banks are going to be there to intervene and try to get those currencies under control based on their monetary policies. So, in other words, currencies move slowly, which is not a problem for traders because we trade on leverage, okay? And because we trade on leverage, okay, even though you may have a tiny movement, because the leverage may be 200 to 1, so the tiny movement you just caught pay you times 200. And that's pretty decent, okay? Now you just made a very, very decent profit, okay? But again, when it comes to the price movement, okay, like putting on the side dollar profitability or whatever currency you measure your profitability, putting on the side that, simply looking at the price scale here, okay? When you look at those figures, okay, we are always dealing with 5 decimal places when it's most currencies, okay? And 3 decimal places, let me write it down. So 3 decimal places for most currencies and 3 decimal places for yen currencies, okay, for yen FX. Why? Well, because the yen is such a weak currency that, the way the price charts are calculated, they end up with 3, because if it was 5, it would be like 1.000. It would be so many decimal places. It would be crazy. So the way the price charts are calculated is with 3 decimal places, just because the yen happens to be a very, very, very weak currency. Okay, I'm not saying the economy is weak. I'm just saying the currency was hurt very badly many decades ago. It was one of the first countries in the world that. Again, this is not a lecture on economy, and I would not be the expert either to do that. But Japan, went through a very big problem in their economy many years ago. They went into a very bad recession. They went into a very strong deflation, and basically the currency just lost ridiculous amount of buying power, lost a lot of value. On top of that, they did a lot of currency intervention in the form of what is commonly or very elegantly known as quantitative easing, which means they printed a lot of currency and the yen became so weak. Okay, this is the reason why, if you look at the, for example, the US dollar yen, right here. Actually, I don't need to load a chart. You can see it as well here. Okay, it's 3 decimal places. Okay, you can see it here, 3 decimal places. Where if you look at the euro, for example, or any other currency, is 5. Okay, so we're going to have to make a distinction when trading Forex and treat differently the currencies that are yen based or not yen based. Okay, so and again, so now picture yourself in a trade where, for example, you buy the euro at 112.039 and the euro goes up to 112.023, 112, yeah, for example, something like that. Let's make it like that, 029. I didn't do this right. Here we go, 23.9. So if that was the case, okay, if you bought at 112.039 and you sold at 112.239, if you were to do the math, okay, what you made is 0.00200. Okay, that's what you made. And go ahead and try to pronounce that. Okay, so I mean, I'm not saying it's not possible, but it's quite uncomfortable, isn't it, as a person, if you were to talk like that. Your trading friend tells you, hey, how did you go today? And you say, hey, today I made 0.00200. It's not comfortable. So in the world of trading Forex, okay, and I don't know how it happened, but I guess that is just humans looking for more comfort on how to express ourselves. We came up with a standard in the industry, which is for currencies that are not yen based, every time you have a movement on the fourth decimal place, okay, no matter what you have in the fifth, every time you have a movement in the fourth decimal place, we call this 1 pip. That's how it's known. If it's a yen currency pair, then it's going to be the second. Okay? Every time you have a movement, no matter what you have on the third position of the decimal places, you would call it a pip. Okay? So for example, in this case, I made 0.00200. So what you would do is that you would just focus on the fourth decimal place, okay, and from there ignore what's on the right and only focus on what's on the left, okay. And if you look at what's on the left without crossing the decimal place, okay, you stop there. If you were to focus on what's on the left without crossing the decimal place, what did you get? Well, you got the number 20. So in other words, how much is 0.00200? It's 20 pips. And that's how we talk. So if your trading friend would ask you, hey, how much money you made yesterday? You would say, I made 20 pips. Okay, that's how we speak. And really it means you made 0.00200. And again, this could be a great profit, by the way, even though it's a very small move because of the leverage. And then we need to talk about the size of the trades in Forex and all of that, okay? If it was to be a yen currency, remember, with the yen currencies, you are dealing with less decimals. Okay, so let's say you have this. Okay, let's say you have this. I'm just gonna do this, for example, right? So what would you do? Okay, or let me do this just to make it a little more interesting. So what would you do, right? So what you would have made in this case, being yen, okay, well you would have made if you do the math, let me invert it, so that way it's going to be easier for the math, right? So if you take a calculator, I mean, not really need to take a calculator, but just to be visual, let me bring a calculator. So you would have made 126.9 minus 113.9. So you purchased at 113.9, you sold at 126.9. So how much you made? You made 0.13. Okay, 0.13. So you would come in here, you would type 13, and remember the following decimal place doesn't matter, which in this case, kind of conveniently, I selected 9. Okay, you know what? Let me make it a little more interesting. So I'm gonna make 7 below, and maybe just to keep it a little more simple, I'll keep 1 above. So for example, if you bought a 113.7 and you sold a 113.9, so you sold it at 169 and you purchased it at 113.7. So how much you made? You made 0.032. So in this case, you would have 0.32. Okay, that's the profit you made. Remember, when talking about pips, okay, you would ignore the last decimal place. Okay, because it's a yen currency pair, you would focus on the second decimal position, okay? Focus on the second decimal position, so ignore what's on the right, focus on the second decimal position, move to the left without surpassing the decimal point, and what number did you get? 3. So if someone asks you how much you made trading the yen, you would say, I made 3 pips. That's what you would say, okay? Now, to be precise, you would have made 3.2 pips, but now you are kind of defeating the purpose of using pips. The reason why we use pips is to make it simple when we call it, okay? So it's common in Forex to simply ignore the 5th decimal place, okay? And all your order placements, when you plan the trade, etc., every time you type a price in Forex, it's very common to ignore the 5th decimal place, because to be precise, the 5th decimal place is actually known as the fractional pip, okay? So there is a name for that, okay? It's fractional pips. So you could say, to be very precise, you would say, I made 3 pips, okay, plus 2 fractional pips, okay? So you could speak like that, but if you speak like that, now you just make it complicated, right? So again, the purpose of using the word pip is to simplify how we express ourselves when we define the size of a move trading Forex, okay? So, hey, my stop is 5 pips away, okay? Well, if your stop is 5 pips away, it means if you trade yen, it means it's that far away, 0.05. If what you trade is not a yen currency pair, you trade, let's say, any other currency, for example, the Australian dollar against the Swiss franc, and you say my stop is 5 pips away, then it means that your stop is 0.0005. So again, the 4th decimal place, okay? 4th decimal place for most currencies, okay, and 2nd decimal place for yen FX, okay? So that's what we have. That's what we have when it comes to the definition of what's pips, okay? Which again, probably you knew it, or at least you heard this term before. But again, super important, because, as we start planning trades, I will begin, giving instructions using this term, okay? I'll be like, hey, target is 50 pips away, right? So we need to speak the same language here, okay? Good. So, Bojan, Jose, an odd question. How these exchange rates relate to real world money exchange? Okay, well, the exchange rates that we trade when we trade spot Forex, those exchange rates are coming from your broker, and the broker is connected to top tier banks in the world that provides institutional pricing for those currencies. In other words, 112, okay, if I go back to the euro, 112, it's the institutional rate for you to get euro if you had a way to get euro at an institutional rate, okay? So that's the real price of the euro. That's the real price for the currency exchange rate between the euro and the US dollar, is the real one, okay? The broker may add, we'll talk about spreads and things later on, so the broker may modify slightly the price, but again, this is the closest you will get to the real price of the currencies. Okay, now a different story is now you want to go on vacation to, let's say you live in Canada and you want to go on vacation to Portugal, which uses euro. So what happens? Well, if you exchange the currency in the bank or in the airport, well, those currency exchange services, those counters for currency exchange, they're just gonna take advantage in the form of arbitrage of those travelers, okay, and just make the bid price and the ask price for the currency to be far away from 112. So that way they create for themselves a spread and they keep the difference, okay? They will collect from the bank at an institutional rate the currency at 112, and they will sell it to the traveler maybe at 112.50, and they keep the difference. Okay, they can do that because those companies normally they are large enough to be able to negotiate with the banks to have physical delivery of currency at the real rate. Okay, but for the individuals, normally it's not possible. Okay, so but bottom line, when we trade spot forex, because we are connected to the broker and the broker to the top tier banks, what you get on your screen is the closest it gets to the real rate. Okay. So hopefully this answers your question. Okay, Bojan. Okay, that's what I assume happens, and funny enough, that's the reason I asked, since we're traveling soon. Here we go. Yeah, so it's always, I would say, it's always a little frustrating as a professional trader to travel and do currency exchange in places. Okay, because you always got a normally pretty bad price. Okay, so little trick there. You may want to look for a bank that gives you credit cards with no fees for the currency exchange, and they give you real-time rate based on typically the close of the prior day or something like that, and therefore you get as close as possible when you do credit card transactions. You get as close as possible to the real rate. Okay, but the moment you withdraw money in an ATM or you go to an exchange place, that's it. Now you're gonna have to suffer a little bit of slippage there. Okay, which I guess is fair, even though sometimes it's very, very exaggerated, because those places, they take advantage of people, because most people don't even know the euro is 112. Okay, they just exchange at whatever rate is available because that's what's available. Okay, so they don't have a proper understanding. But anyway, coming back to trading the currency markets, even though it's nice to travel and also get to see those currencies out there, so you get to understand what I said before, that it's less tangible, but it's real, right? So, those are key terms, okay, that we need to all understand to be able to work together in this sharpening session to learn the currency. So first, what's Forex? What are the central banks? The fact that there are many currencies, the fact that we will focus on the majors. We will open the door to a collection of cross pairs as well, based on liquidity. And the exotics, they are there, but normally we don't trade them. And then we also talk about the currency markets, to be normally moving very slowly. It's funny because most people have the belief that currencies are very volatile, which is absolutely not the case. If you take a currency which is not volatile and you use a broker that gives you 500 to 1 leverage, then yes, you can make a lot of money and lose a lot of money very quick, but it's because of the leverage, not because of the volatility. Okay, so currencies are very nice markets to trade, very, very safe, large, so large, the largest in the world, because you don't have an exchange. Currencies are worldwide, so you benefit from the worldwide liquidity instead of the liquidity from one exchange. Okay, and then we talked about the fact that when we trade currencies, we use the word pips. Okay, so if everybody's with me on everything I just said, please give me a little bit of a confirmation on the comments box, so I know all of you are following, and also just tell me if I'm going too slow or too fast. Okay, because if I go too slow, I'm happy to accelerate a little bit at the same time. I don't want to lose anyone. Okay. Now, what else? There is another important conversation we need to have before we get into charts and material that is a little more exciting, okay? Which is the size, okay? So we need to talk about, the size, okay? The size when trading Forex, okay? Because when trading Forex, okay, again, you trade currencies, and, the spot Forex market has a very, very specific way. Yeah, got your point, guys. So the spot Forex market got a very, very specific way on how to define the size. Again, it's regulated. Okay, earlier I mentioned ISO that regulated how the currency pairs are made. Well, the size, okay, even though there are very, very few brokers out there that allow you to input when you take a trade, you can input maybe I want to buy 12,355 euro, right? And you can input it in this fashion, even though some brokers will allow you to do that. The fact is that this is the minority. It's actually rare to find brokers that allow you to trade like that. Most brokers, they will allow you to trade in what is known as lots, okay? Lots of 1,000 units of currency at a time, okay? This is known as micro lots, okay? Or lots of 10,000 units of currency at a time. This is known as mini lots, or combinations of 100,000 units of currency at a time, and this is known as standard lots or just lots. Okay, and notice I said units of currency because this depends. For example, if you tell me that you're gonna buy the Euro USD and you're gonna buy one lot, okay, so what does that mean? Well, that means that you are purchasing 100,000 euros. Okay, but if instead of the euro you tell me that what you're buying is the pound, so you're buying a lot of pound, well, that doesn't mean a lot, it means one lot of pound. So that means that you are buying 100,000 pounds. Okay, I don't have the symbol for the pound in my keyboard easily. So that would be the case, right? If you were to do US dollar Swiss franc, right? And you say I'm buying one lot of US dollar Swiss franc, it means that you're buying 100,000 US dollar. Okay, so you will exchange whatever amount of Swiss franc to get to 100,000 US dollar. Okay, so that's what units of currency means, is whatever currency you have in the base. Okay, the first currency on the left. Okay, so in other words, you have when trading Forex, you have micro lots known as micros, you have mini lots known as minis, and you have standard lots known as lots. Okay, so that's what we have, and that's what we use when trading Forex. Okay, micros, minis, and standard lots. Okay, and this will have an impact on the profitability of the trades. Okay, it will also depend on the currencies, because of course it's not the same to have 1,000 lots of euro than having 1,000 lots of US dollar. Why? Because the euro is 12% greater value than the US dollar, right? Because it's 1.12. That's 12% higher. So obviously this will impact the profitability of your trades. Okay, but right now, out of terminology, I just wanted to put it out there, and I'll have to come back to this and get a little deeper into how to calculate all of this. Okay, what else? Well, we have in Forex, we have something called swap rates. So let's talk about swap rates. What is swap rates? Okay, well, again, we are used to load a chart, in this case the euro. Next thing you know, you open an order bar. Let me connect to paper trading, for example, so you can see the order bar. Here's the order bar. So now you have the order bar, and now you place an order, right? And we are used to trade using these tools where sometimes it's almost like you forget what you're trading. It's like you don't even care what you're trading. You just place an order, right? But again, coming back to the tangibility of the products that we trade, remember, if you buy the euro against the US dollar, you are acquiring euro, real euro, no joke euro. Okay, so now what does that mean? Let's say you are trading in the US and your broker is located in the UK and you just bought euro. So what happens? Is the UK broker going to do a wire transfer to your bank account with euro? Is he going to send a parcel with the euro inside, and that will be delivered to you physically at home? Well, all of these will be quite problematic, isn't it? Okay, you would have risk of being stolen. Now you have to save it, you have to store it, and the worst part of all, now you need the money to do the trade, right? Because if they're going to give you physical delivery of the currencies, it means that you have to pay for them, right? So if you want to exchange euro by selling US dollar, so acquire euro by selling US dollar, you need to sell US dollar. And if for you to acquire 100,000 euro, you need to come up with 112,000 US dollars. Is no way you can do the trade unless you have $112,000, right? And we know that when trading Forex, we trade on leverage, which means that we actually use less money, right? So if, for example, again, reutilizing the figures I just shared, let's say you want to purchase 100,000 euro, which at the current rate, it would cost you 112,000 US dollars, right? And instead of you come up with that money, you want to trade on leverage, and let's say you found a broker that gives you 100-to-1 leverage. Well, 100-to-1 leverage means that you need 100 times less. In other words, you need $1,120 to be able to get into that euro trade. But if you were to ever get physical delivery, I mean, there's no way a broker will deliver to you the full 100,000 euro if you only put on the table $1,120. Is that making sense? In other words, in order for you to get leverage, the brokers have to avoid the delivery of the currency. And also, we traders don't want the currency delivered to us because, again, it's a hurdle. Now you can be stolen, all those things, right? So what happens? How is this process happening behind the scenes? There is every broker will have an accounting department, right? And how do they work on the ledger? What do they do behind the scenes to be able to take care of that trade? Okay, to basically pass that money into you so you can do the trade, but not deliver it to you. While on top of all of this, there is something very important in currencies, which is currencies are exposed to an exchange rate. Okay, because financial markets are efficient. Okay, I mean, it's not like those things are done manually. Everything I'm about to explain is done automatically behind the scenes by computers. Okay, and so if, let's say, for example, a trader has funded a Forex account with $10,000. And now he's in a trade where that trade is utilizing $1,120 of buying power to purchase the euro in exchange for selling the US dollar. Well, it's not like that money is going to be sitting on an account doing nothing. Okay, what's going to happen is that automatically those Forex brokers, they're going to be purchasing in the same currency to avoid currency risk. They will be purchasing bonds, short-term duration bonds, typically 30-week treasury notes, or things like that, 13 weeks treasury notes, which are liquid, you can get in and out during the day, okay? But they will be purchasing that automatically the moment you get into a trade. And therefore, they basically get the money to work, right? So if you open a trade with this amount of money and the broker was to take that amount of money and was to purchase bonds on that bonds that belong to that country in that currency, well, now that money will start deriving an interest rate, okay, which is good for the currency you have acquired, because with the currency you have acquired, you have purchased bonds. But what about the currency you sold? Well, with the currency you sold, that money was invested in bonds and you had to sell the bonds so you can sell the currency. In other words, you are giving up on some interest rate in exchange to get another interest rate, right? And the question is, like, for example, at the moment at which we speak, the euro has a lesser interest rate compared to the US dollar. So if you were to buy the euro, and for you to buy the euro, you have to sell US dollar, basically you are giving up on a large interest rate in order to collect a smaller interest rate. So basically you have a negative differential, and basically you would be charged a swap rate once per day, 5 p.m. Eastern time. That's when most brokers do it. You would be charged a differential of interest rates. In other words, it would cost you money every day to be in the trade. Why? Because given the currency pair that you traded long, in this case, you bought the euro in exchange to selling the US dollar, that's long. So because the euro has a lesser interest rate than the US dollar, you have this negative differential. Now, the opposite is true if you were to short the euro US dollar. Because if you were to short the euro US dollar, you would be selling the euro in exchange for buying the US dollar. And because the US dollar has a greater interest rate at this moment in time, so you would be giving up on a lesser interest rate to acquire a larger interest rate, and that would actually produce a positive, swap rate in this case. Okay, so swap rates can be positive or negative. Okay, and normally they are charged or collected per day, typically at 5 p.m. Eastern time. Okay. There is an exception to this, which has to do with Islamic accounts, okay? Islamic accounts, okay? So this is something that you may want to consult with your brokers if this is interesting to you or not, and also depending on your religion in this case, because this has to do with Sharia law. Some brokers, some countries have banking laws that follow the Sharia law, and therefore charging for borrowed money is not allowed based on the Sharia law. Therefore, some of those forex brokers, they process the currencies in a way where they do not generate any of those interest rates, and therefore they can give you what is known as a swap-free account. Okay, but again, brokers will have requirements for that. Not all brokers will give you that service, and also sometimes they may give you swap-free for the week, but if you stay in for more than a week, they charge you something. So again, it's a little bit of the Wild West when you get into Islamic accounts and swap-free accounts, because when I mean Wild West, I mean that every broker will treat it differently, if you wish. Where with most brokers, where you do have these differentials of interest rates, what we call swap rates, almost all brokers will treat it the same way. Okay, so let me show you, for example. So if I get into forexfactory.com, which is a very known website for currency exchange, let me click on the calendar, and then I'm going to scroll down all the way to the bottom. I love this page because you have this very nice, illustration of the central bank rates for the key currencies. Okay, those are the 8 currencies I mentioned before. Those are the most important currencies in the world. So you can see, for example, at this moment in time, the US dollar is the place in the world with the greatest exchange rate, okay, where Swiss franc is the worst, okay, for exchange rates. Okay, so what happens if you get into a trade with the US dollar and the Swiss franc? Okay, so you can go ahead and type, let me see, swap rate calculator. For example, XM swap calculator. So XM is a broker. So let's take a look. Okay, there are many tools like that in the market on the internet. Okay, so I'm looking at swaps. Okay, and what I want to do is first select the base currency. Okay, the currency on the left. Okay, so let's say, for example, I am buying US dollar, right? Because I was pointing at US dollar against Swiss franc. Okay, top and the bottom. So currency pair, US dollar, Swiss franc. Okay, account type. Okay, are you doing a micro account, a standard account? So I'm just gonna use standard. Okay, a standard account means that one lot is a full lot. A standard lot is 100,000. Okay, this broker also offers micro accounts. Okay, so that's why. Okay, but so let's go for standard. Okay, and let's say you traded one lot. How much is one lot? Well, one lot is 100,000 US dollar, okay, acquired by selling Swiss franc. Okay, so if you were to do that, click calculate, and what happens? Okay, what happens? Well, what happens is that if you were to get long, okay, every day you would be paid $6.49 per lot per day. So you would get that 365 times in a year. If you were to get short, now you would have to pay $12 a day. Okay, notice how you will need to actually pay to be in the trade every day. Okay, this is, by the way, this is something that not all forex traders fully understand, because many forex traders may trade intraday and they may not realize this. Okay, and then they are charged swap rates and they're like, what's that? That's important for you to understand. We need to talk about carry trades at some point. The carry trades are a fantastic application of this, because think about it. So let's say I get $6.49 per day times 365. This is $2,368.85 per year. Okay? And this money is made in a year, okay, out of being in a position size of $100,000. But remember, for me to trade $100,000, I don't need $100,000 because when we trade Forex, we trade on leverage. So for example, if we pick America to pick a country, America has a regulation in Forex, okay, same in the UK, where the most the brokers will give you is 50 to 1. In other words, for you to trade 100,000, you need 50 times less. This is $2,000. Okay? So in other words, with $2,000, you would get into a position size of 100,000, and this would pay you, we said, 6.49 times 365. This would pay you 2,368 divided by 2,000, which is the amount of money you need. This, my friends, is an annualized rate of return of 118%. Basically, you doubled your money on swaps. Now, of course, during that 1 year, the US dollar Swiss franc may have moved against you all the way, and you have been completely killed because the currency moved against you. But imagine, and that's what we know by, that's what I mean by carry trade. Imagine being in a trade where you are trading in the right direction in a long-term time frame, and you are in a trade for 2 months, 3 months, 6 months, whatever. And while you are in the trade, you are receiving swap rates at that rate. It's pretty cool. And the opposite is true. Imagine shorting the US dollar Swiss franc without knowing that you need to pay all that penalty. Is that making sense? So again, swaps could be quite important or critical. And by the way, every broker will have different swap rates, because even though the interest rates from the bonds are the same, every broker will keep a portion for them, and every broker will keep different. Notice how, I mean, think about it. How can it be possible that, you know, if you are taking this currency and you invert it, in other words, instead of long, you go short, or short, you go long, this should be positive 649, negative 649, negative 649. How come it's negative 12? Okay, well, that's, the broker is doing a nice business there. Is that making sense? So every broker will be, basically adding or keeping for themselves a percentage of that as well. Okay, but anyway, it's quite powerful, those swap rates. Okay, and normally again, most brokers will pay or subtract the swap rate once per day. Okay, now we need to talk about Forex futures, okay, or currency futures. One big difference is that there is no swap rates in the currency futures markets. Okay, but it doesn't mean you don't suffer the rates. I mean, they are priced in the futures contracts. Every one of the futures contracts got an expiration date, isn't it? So guess what? The swap rate is priced in. And that's why, if you look at the price of the euro, for example, here, which is 112.03, and I compare the price of the euro spot with the euro future, it's telling me 112.23, right? Instead of 112.03, right? So what's the difference? Well, instead of 112.23, you got 112.03. So what's the difference? It's 20 pips, okay? 20 pips. 20 pips out of 112.03, that is 0.17%. Okay, 0.17%. And how is that number calculated? Well, futures is a different animal, a different story, and it's not the subject for today. But basically, you could see this, okay, as the differential between today until the expiration date of the futures contract, which is going to be the 3rd Friday of June, right? So, this is the residual interest rate that, the extra money you are paying here, okay, that you would not be paying in the spot Forex, but if you were to hold it until the same expiration date, basically you would be in the same position. Okay, so in other words, all of this is accounted for. It's not like you're gonna find an arbitrage opportunity where you buy the euro futures and you short the euro spot, and then you keep the interest rates with no market risk. Okay, well, that would be amazing, but that's not going to happen because the interest rates are priced in the futures. Okay, and because they are priced in, then you don't get to pay swaps, okay? Or you don't get to receive swaps either. Very good. So just catching up with the chat box. Suhaj, I hear you, my friend. Not a worry, not a worry. Nice to see you. Anyway, so let's do this. Basically, I would say almost all the key terminology I needed to put on the table before we start getting deeper into Forex, we have it out there, okay? So what I'm gonna do now is I'm gonna give you 5 minutes of break, and as we come back in 5 minutes, we will continue with all of this, and we're gonna start taking this to the next level, okay guys? So see you in 5 minutes. Okay, everyone, this is Jose. We're gonna restart in 25 seconds. Just a sound check here. Please type something nice in the chat box, something currency related, so I will know that you are listening to me and sounds good. Type your favorite currency. Wonderful. Thank you, guys. Okay, so let's continue here. Okay, again, today it's our first Forex day. Okay, and obviously this beginning part of the session has been, let's call it a little slow. Hopefully it's okay for everybody to follow, especially if you never traded Forex before. But really, the exciting part, you know, is when we jump in the charts and we look at the trades and all of this, right? So, but again, it's very, very important that you get to understand everything that we said because it's critical. Okay. Good. So anyway, so good. So guys, let's talk about time frames. Okay. Let's talk about time frames because obviously, you know, a chart is a chart. Okay. So a chart is a chart, and you can go ahead and you know, pick the euro in the 1 minute time frame, and you know, you have the chart, you have the UFOs. Let's go trade. Does that make sense? You could do that. Okay, you could, but I would certainly not advise you to do that. Okay, you know, the very, very, very low time frames in Forex are going to be problematic. Okay, and it's not because Forex is different. It's not because the UFOs, whatever. It's not because the trend in Forex or the news in Forex or whatever in Forex. No, it's simply because when dealing with Forex, we are dealing with a market that is not centralized. There is no central exchange. And what are the implications? Well, the implications is that not all brokers will have the same price. Okay, so for example, when you look at, let me put it here. So I'm just gonna delete the euro, okay, on my watch list. And here below, I am going to add more watch lists. And watch this carefully. If I type EUR/USD, under Forex, notice that I have 1, 2, 3, 4, and 5 euros, right? With FX. I got 5. Then later we got, you know, exchanges in Russia and you know, if I scroll down more, even more, right? But for example, the first one, this is a euro data feed provided by FXCM, which is a broker. So I'm gonna add it. Okay, that one is showing the euro as 112.039. But what if I add the second one, which is Oanda, which is another broker? Okay, so when I do that, okay, it's showing us 112.038. So it's a little different. But what if I go for Euro USD number 3, which is forex.com, which is Gain Capital? This is 1035. Okay, and what if I go for the next one, Euro USD, which is the ICE, which is an aggregated data feed? That one is 10202, right? And what if I go for Saxo, which in this case really is not Forex, it's CFDs, which we'll talk about that. Okay, contracts for differences. Now it's 02058. So what's going on? You know, there are some differences here. Okay, and if you were to trade the euro with such a tiny time frame, so what would be happening? What would be happening that, you know, you may not get filled and it moves your way, or you may get stopped out and it moves your way, or your UFO is in a different location depending on which broker, and it's just because the data feed that you are utilizing, okay, is reflecting that one broker, which is not a reflection of the whole Forex market, which happens the biggest market in the world. So how can you avoid the problem? Well, avoiding the problem has a lot to do with using larger time frames. That's how you will avoid the problem. Because look, if I use the FXCM data feed, I have this UFO located. I mean, let me labels with no overlapping. Okay, so like for example, this one is 112.01. Okay, I got a UFO here at 112.01. If I load it on Saxo, for example, the 112.01 becomes 112.03, 112.008. Yeah, but you see how the numbers change? Again, and this is a CFD, so CFD is actually technically a different product, but if I look at the aggregated data feed with ICE, I get something really weird on my screen, again, which is difficult to interpret, okay? And again, if I was to do larger time frames, it would not be that bad, okay? If I go for forex.com, I got 112.011. If I go for Oanda, I get 112.010. Okay, so again, we have differences, okay, and sometimes, as you have seen, they are quite major. If I, instead of using the 1 minute time frame, I was to use, let's say, the 21 minute time frame, okay, so if I use the 21 minute time frame, I will still have differences, as you will see. For example, this red UFO is located at 112.06, 112.062. If I move to FXCM, is actually, I don't have a red UFO with FXCM. If I look at forex.com, is 112.07. Okay, so I still have differences. Okay, I still have differences, but now, okay, with the ICE data feed, there is nothing. Okay, so I still have differences, but those differences are less important, because what really matters the most is not the price of one of the lines. What really matters the most is all the UFO band, if you wish, all the zone, okay, between which we find all the two lines, you know, the zone between the two lines, between which we find those on-field orders, where we have the little round circle, right? So, you know, the larger the time frame, you have probably identified or realized that the wider the zone. So for example, in a 21 minute time frame, I got 52 to 58. That is almost 7 pips. So if I was to move to, let's say, a 4-hour time frame, okay, what happens to the zones? 29 to 43. So my 7 pip zone becomes like, you know, almost 20. Okay, so the larger the time frame, the wider the zones, the lesser the time frame, okay, let's say 3 minutes, then the lesser the zones, okay, and this I will need to scale it properly, okay, and therefore, you know, again, what you could not do with Forex, spot Forex, a different story is futures. I'll be commenting on your question, Andrea, in just a minute, but with spot Forex, using too little as time frames would be a major mistake, because, you know, again, given the fact that there is no central exchange, those data feeds are different, and therefore you may be entering in places where it's not relevant anymore. It may be relevant in your broker, but it's not in the market. Okay. So the only way to mitigate this problem is to not to use time frames that are too low. So therefore, I would like to propose and draw a line at 15. Okay. The lesser time frame to be used in Forex will be 15. Okay, 15 and higher is okay. 15 and lesser, it's a little tricky. Okay, you can go for 8. Okay, and I have planned at times trades with the 8 minute time frame, but only with the majors. Okay, I will not go for cross pairs and funny trades with such a small time frame. Okay, so I think it is healthy for you to keep in mind 15, and if you want to make an exception and go for a little bit less, okay, 8 and 5. Well, if you have a very good broker with, you know, very good data feeds that you have identified, and you apply it only to the majors, then it could be okay. But again, it's many what ifs. You get my point, and therefore my proposal to you to just make it simpler, you know, is to not to go too low in those time frames, given the fact that the nature of Forex is decentralized. Okay. So that's one reason. The other reason as well is that let me load a DOM. And of course, this is not the ideal time to do this because the market is closed. Yeah, so we don't get to see it because the market is closed. Okay, so look, I will leave you this for you to look at it during market hours. You know, starting Monday morning Asia time. Getting here, this bottom on the right is the DOM. This is what TradeStation calls the matrix, okay? Depth of market is the same thing. So when you click on the dome, you get this type of tool, okay? And basically, when the market is open, on the right, on the left, it will be flashing where the bid price is, and on the right, it will be flashing on where the ask price is. And you will see that again, same story. If you change from broker to broker, for example, FXCM, well, actually, funnily enough, FXCM does show it. The bid price is 0.51, the ask price is 0.59. So we got almost 1 pip of bid ask spread. The bid ask spread is the difference between the bid and the ask. We call it the spread. It's almost 1 pip, okay? To be precise, it's 0.8 pips, okay? That's the spread. I cannot see on the other brokers, but during market hours you will, and you will see that if you go to the next one, maybe instead of 0.8, it shows you 1.5. And then you go to the next one, and maybe it shows you 0.6. And then you go for the next one, and maybe it shows you 1.4. And basically, depending on the broker that you use, not only the prices in the chart may be slightly different, on top of that, okay, the difference between the bid and the ask price may also be different depending on brokers. And here is another challenge, and this is super important for you to understand, of trading Forex. Okay, and again, I use the word challenge because it is, but at the same time, it doesn't mean that this market is not amazing to be traded. Okay, look, these prices that you have on the chart, okay, is the bid price. It is kind of a common thing in the industry. When you load a Forex chart, I would say 99.99% of the platforms out there available give you bid charts, okay? Bid charts. And if you think about it, that is what you get when selling, okay? Because who do you sell to? When you sell to the buyers, and the buyers are bidding. So if the buyers are currently buying at 112.02, and that is their bid, and you were to sell, you will get filled at 112.02. Okay, so in trading, there are 3 prices for you to keep in mind: the bid price, the ask price, and the last. So the last price is only available in exchanges, right? So for example, when you trade futures, okay, if you see on your chart, whatever, the euro is 112.23 and is euro futures, that is not the bid, it is not the ask, is it the last? And the last means is the last trade that took place, that was registered in the exchange and is being reported on your chart. But remember, in Forex, there is no exchange. So there is no one reporting anything. So what the normal thing is that you get bid charts. And again, that's great when you're selling, because when you sell to the bid. And therefore, whatever you see on the screen is the price you get when you sell. But what about when you buy? Okay, and you may buy to go long, or you may buy to close a short, right? Or even a stop, right? So it could be a buy order. So when you buy, you actually get the ask. So for example, if in the prior broker with FXCM, we had a spread of 0.8 pips, okay? And the bid price, okay? Current bid is 1.12039. Well, knowing that the spread is 0.8, the current ask price is 1.12, and that would be 0.47 if I'm not mistaken, if I didn't make any mistake on the math. Okay, so the ask price is 0.8 pips higher. That is 12.047. Okay, and what are the implications? Well, imagine that you wanted to buy, and you wanted to have an order to buy at 112.04. Okay, let's say you want to buy. Okay, I want to buy at 112.04. So if I want to buy at 112.04, it means that the ask has to be 112.04 for me to get filled. But for when the ask is 112.04, then the bid will be 0.8 lower. So it will be 112.032, isn't it? So let's say I place an order to buy at 112.04. And the euro went down, 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 down. It's coming down, coming down, coming down, coming down, coming down, and got to 112.039. So even though 112.039 is lower than 112.04, guess what? I would not get filled because, you know, that's the bid price. For me to get filled at 112.04, I will need this chart to fall just a little extra to reach 112.032, and now I will get filled on my order at 112.04. Okay, and the reason why is like this is like this. Okay, and if I went a little too fast, I'd like to ask you to rewatch this in the recording. But the reason why this is like this is because we are dealing with spot forex, which is a market which is not centralized. And therefore, you need to keep in mind at all times that what you see in front of you is the bid chart, okay, is not the ask chart, is the bid, okay? And when you buy, you get the ask, okay? So we always need to have an extra step when buying, okay? Just like later, I'll talk about stops as well, okay? Very good. You're very funny, Dirk. Yeah, maybe I should make my fonts just a little less, isn't it? But anyway, good. So where are we at? Okay, so we talked about all those concepts, okay? And now when we are talking about time frames, okay, what needs to be kept in mind is not ideal to go below 15-minute time frame, okay? May be okay to drop up to 5-minute time frame, but only for the majors, okay? So keep those rules in mind, okay? And the other thing that we just realized as well, which is one of the reasons why we use those particular time frames, is also that when placing orders with forex, okay, when placing orders on forex, okay, you will always need to ask yourself two questions, two key questions, always when you place an order, okay? Question number one is, am I buying? Right? Because if you are buying, I'm going to have to give you a rule and tell you what you need to do, because you cannot buy at the bid price, you need to buy at the ask price. Okay, so I'm going to give you a rule in just a minute. Okay. The second question you will need to ask yourself as well is it a stop? Okay, is it a stop order? So is it a stop order or is not a stop order? Okay, so you will need to ask yourself those two key questions, because based on those two key questions, you will have to do something, which I'm going to teach you before we finish the session today, which has to do with the nature of Forex being decentralized and the fact that different brokers, as you have seen, I think it was quite clear, different brokers will give you different price points, very subtle difference, but you need to keep this, you need to incorporate this into your placement of orders. If not, the risk would be that you get stopped out and then you see the market go your way. Okay, and just because another broker just got, the orders like, 1 pip away. Okay, so we need to make sure that we keep this in mind. Okay, good. So now, keeping all of this in mind, and again, there are a few rules I need to give you. How are we gonna trade Forex? Okay, how we're gonna trade Forex. Okay, and the answer, to be honest, you know it. Okay, the very same methodology that we have been exploring on how to trade futures intraday using a common time frame, an edge time frame, and a reactive time frame. That very same methodology is the very same methodology that we're gonna be using to trade spot Forex. The only difference is the time frames. We will not use it. For example, in this case, what I have here is the @EC. This is Euro futures. And what I'm doing is I'm using the 15 as a common time frame, the 2 minutes as a time-based time frame, 377 share bars, 233 tick bars. Well, why can I do this? Because it's futures, it's currency futures. Okay, it's Forex futures. So I can do it because it's futures. But what if I do spot Forex? Okay, well, if I do spot Forex, we just said we cannot do that. Okay, we cannot drop the time frame so low. So how are we gonna deal with it? Well, so let me introduce you to the set of time frames that we are gonna be using in Forex trading. We're gonna be using, okay, and I'm gonna give you two choices. Okay, so in a perfect world, okay, one sec. Something funny is happening. Just give me a second, guys. For whatever reason, I cannot get my mouse where I need it to be. Okay, now. Got it. So, in a perfect case, you would be able to use the section on the left on this particular screen. Okay, on the left I got common time frames, blue color, edge time frames, which is dark gray, and reactive time frames with a white background. So let's begin with the common time frames. And by the way, I loaded the wrong one. Let me get the one for Forex, which is this one. Let me see. This one. Okay, I got it now, guys. Sorry for that. So common time frames, edge time frame, and reactive time frames. Okay, so let's begin with the common. The two common time frames we will open the door to is 60 minutes and 240 minutes. Okay. I will say it very quickly because we don't have time and because we have had sessions on intraday trading before and it's covered there. But 60 and 240, those are the time frames that we use to understand which is the right side of the market in which I should be. Should I be long? Should I be short? And we do this by looking at the trend and the moving average and the DMI and all those things that we do, which I am not going to repeat myself. Okay. So if you do spot Forex for intraday trading purposes, you would be looking at the common time frame 60 and 240. You would not go lower than that with spot Forex because of the decentralized nature of spot Forex. If you wanted to go lower than that, then you have to use currency futures. And then you would do what we have already explained. Now, if you were to use 60, which is the edge time frame to be used? 8 minutes. Okay? If you use 240, which is the A time frame to be used? 21. Those would be your time frames. Okay? Now, not everybody, depending on the platform that you use, depending if when using TradingView you have a basic plan or you have a pro plan, you may be able to do customized timeframes, which are the edge timeframes, or you may not be able to. Okay, so let me show you. Let me show you here. So if I load TradingView and I look at my timeframes, notice how 21 minutes, I got a little X there. What does that mean? It doesn't come by default. I can remove it. It's gone. How do I add it? Notice that below, I can type the time frames I want, 21 minutes. I can add 1, 2, 3. The moment I add, here is my 21-minute time frame. Okay, so I can customize time frame, and the reason why is because my username, I am logged in as Tradictive, which is our company. So my username is a pro plan user with TradingView, and I have accessible this functionality. What if you are using a basic plan, which is the free one? Then you don't have the possibility to customize timeframes. Okay, so that's why I'm giving you another choice, which is instead of using 60 and 8 or 240 and 21, then here you have or you would use 5 or 15. So you would use 60 combined with a 5 or 240 combined with a 15. 5 is similar to 8, 15 is similar to 21, and those timeframes do come by default in all trading platforms. So maybe you're using MetaTrader or whatever, so you will be able to do it. Does that make sense? So now, there is more to this. I got range timeframes here, and also we have reactive. Okay, so one step at a time. Okay, so let's talk about the range timeframes. Okay, so we are still talking about edge. If I go back to the futures timeframes, okay, again, because we deal with centralized products, you have access to share bars and tick charts. This information is available because it's coming from the exchange. But in spot Forex, even though certain brokers will give you volume information, take a look. So here I'm looking at the 3-minute time frame. Let's make it 15, for example. 15-minute time frame of the euro. I can go ahead and activate volume. So notice I got volume data. Most brokers, next one. Okay, so for example, Oanda doesn't give you volume data. Sorry, that was forex.com. Oanda does give you volume data. FXCM does give you volume data. But careful, because this is not volume data. This is the volume that belongs to that broker exclusively. So that information is not relevant. So how can we have charts that are not based on time without volume data? Well, then that's when we talk about volatility charts. And volatility charts are known as range charts. Okay, they are known as range charts. So you also have range charts on TradeStation, by the way. Okay, so you can also use range charts on TradeStation. Okay, but to me it doesn't make sense at all, especially if you trade futures, because you have the information coming from the exchange. So even though you could set up range charts, to me it's gonna be much more powerful from a common sense point of view to use share bars and tick charts. Okay, so I'm not gonna change anything here. But in spot Forex, I do need to give you a little more functionality given the fact that we have no volume. So what are we gonna do? We're gonna use range charts combined with the minute charts. Okay, that is why when I get that screen back, okay, you can see here that apart from 8 minutes chart, I also propose to use the 8 range chart. Okay, and by the way, and I said that once in a session, and I will repeat it so it's crystal clear for everybody. I have a very limited experience with range charts when it comes to trading them. But I have put many hours observing them. And I have concluded in Forex, not for other markets, but for Forex, I have concluded that there is a pretty okay equivalency between minutes and range. So 8 minutes, 8 range, 21 minutes, 21 range. Obviously, when I shared this table with you weeks ago, and I told you that this table with all the futures markets, with all the different possibilities, is a table that I have built throughout the years, I am very positive and very confident, and I know what I'm talking about very precisely when I talk about this table, because this is actually something that I have personally used in my trading, okay? When it comes to the range charts, I believe that my understanding of them out of observation is it's okay. But you just need to know that I'm being very transparent because that is how it should be. I have not traded the range charts, okay? Even though out of observation and some backtesting, it was pretty clear to me that it makes sense, okay? So what I would propose to set up is a workspace where you are looking at 8-minute charts and 8 range charts, or 5 minutes and 10 range charts, again, because 10 is standard, and 21 minutes and 21 range charts, or 15 minutes and 100 range charts, if you're using a basic plan with TradingView. And if you were to do that, it would look like that. So I'm just gonna go ahead and load a new chart layout. And I'm gonna pick, for example, Forex 60 minutes, okay? So if I load my desktop here with Forex 60 minutes, I have on the top the 60-minute time, the 60-minute time frame of the euro, as you can see here. Okay, so 60-minute time frame of the euro. Okay, what am I doing on this time frame? I'm looking at the moving average. I'm looking at the DMI. I mean, I don't need to repeat myself there. Okay, so you know what I'm doing. But then, and please ignore the bottom charts, the 2 charts on the right. Please ignore them. Let's focus on the charts on the left. Okay, what do I have on the left? I got the 8-minute chart of the euro and the 8 range chart of the euro. Okay, and what am I looking for? Well, I would be looking for, as you know, if the average is 112.02, then I will be looking for on-field orders to buy, green UFOs located around 112.02, which in this case I got 112.04. I got 111.90 something, so I got no trade with the euro. Okay, so I would just keep moving from currency to currency. So this is the pound. So uptrend 127.03. So on the 8-minute time frame of the Great British Pound US dollar, and by the way, look at the watermark in the bottom, 8, in the background, 8, right? That's 8 minutes, but here is 8R, so this is 8 range. So what do I have? Well, in this chart, I got 126.96, 127.11, which is higher, so no pound. What about the Australian dollar? So 69.20. So here I got nothing on the 8-minute time frame, nothing in the range time frame. So no luck with the Australian dollar. What about the Kiwi? So the Kiwi is 65.48, so 65.42, and 65.45. Okay, so almost, but not there. What about the CAD? So we got 134.45, and I got 134.45 in the 8-minute time frame, and I got 134.49 in here. Okay. But it's good because, like for example, here, if I was to take this trade, my entry would be 45, isn't it? And my stop would be above 50 plus. Okay, 50 plus. And here I got red, kind of overlapping that region. Okay, so I got red UFOs in this region, red UFOs in the similar region of price. These are range UFOs, these are time UFOs. And then on top of that, all of this is lining up or almost lining up with that moving average. Okay, so this would qualify as a trade. And basically, instead of doing what we do in future, which is to look at the time, the shares, and the tick in spot Forex, we would be looking at the time and optionally the range. If you don't like range and you don't want to put time into testing it, just forget about range. You just do 8 and that's it. If you additionally want to overlay range on top of time, it's looking good to me to do that. Okay, as I said, I haven't done it myself from a trading point of view, but based on what my observation and so on, it makes a lot of sense. Okay, so that would be the way to do it. Okay, and those 2 time frames on the left, the 8-minute and 8 range, would be your edge time frame, while the one on the top would be your common time frame. If you were to do this using the 240, so I'm loading Forex 240. Subhash, 240-minute trade would not be valid for carry trade. Okay, carry trade would be much more long-lasting. So carry trade means that you're gonna be there at least for a few weeks. Okay, so I think that that would be a little too small. Okay, so let me delete that information from the chart. So what do we have here? So in this case, we have the 240-minute time frame above. That's the common time frame, and below we got 21 minutes and 21 hour, which is 21 range. Okay, so back to the table. If you use the 240, we're gonna use the 21 or 15 and 100. That's valid too. So if you do 21, in this case we have an uptrend. You know, we're talking about 126.84 is the average. Okay, 126.84 is the average. So 126.84, we have nothing in the pound. But what if you look at the yen, for example? So if you look at the yen, 109.58, okay, and here we got 38. Here we got 57.8. Okay, so here actually no is the top of the UFO. So no US dollar yen. What about euro yen? So the average is 122.59, downtrend. So 122.59. So end of the UFO is 59 here, and here no UFO. So no euro yen. What about pound yen? So the pound yen, well, let's get something a little clearer. Aussie yen, well, they're just closing where the average is. So New Zealand dollar yen, so that's an uptrend. The current value for the average is 57. So 57, we have green UFO, okay, and not in the range time frame, but we have it in the time. Okay, so if you have it in the time or you have it in the range, wherever you have it, you can plan on the trade. So in this case, we are now reaching a good buying point for the New Zealand dollar Japanese yen, expecting it to go up, being supported by this new uptrend that is being developing and shows green in the bottom as well, which is strength. Okay, so again, basically, let me repeat myself, you would use the time-based time frame combined with the range-based time frame. That's a volatility time frame, and that's a base time frame, a time-based time frame. You would use it as edge time frames combined with a common. Okay, and the rules are the same that we have already covered. So looking at the right side of the market, looking at the precision for the entry and the targets, and then optionally, if you want to have a manual entry with a type of confirmation, type of wait for the evidence and then enter the trade, okay, well then you would use a reactive time frame, which would be 3388, or in the case of not using a pro plan, you use a basic plan with TradingView, would be 11 or 310. Okay, so going back to my chart, you can see I got 240 minutes on the top. That's the common, 21, that's the edge on the left, and then on the right, 8 minutes, 8 range, that's the reactive. Okay, so you could wait for the New Zealand yen to come into the green UFO, and the moment you get new green UFOs forming on the 8-minute time frame or the 8 range time frame, that would be your indication that gives you evidence that what you thought was going to happen is actually happening, and you would now enter the trade. Okay, so very, very, very same concepts that we have explored and used in futures, but now we are applying them to spot forex and introducing the range time frame, which is something new. Okay, how is it going so far, guys? How is it going, everyone? Oh, sorry for that, just click in the wrong place. So give me a little bit of feedback to see if everybody's with me or not. tick bar chart. Buna, would you mind to elaborate a little more on that question so I understand? So now, what if you want to trade larger time frames with Forex? Okay, well, this would be your combination of time frames. Okay, if you're gonna be using the daily, the weekly, or the monthly, okay, daily, weekly, or monthly, then you will use this particular combination. Okay, so let me do this. Okay, just wanna open a new layout. Okay, in this case, I'm gonna go for Forex daily. Okay, and if I do Forex daily, notice how now okay, it's loading. Now on the top, we're gonna have the 1 day time frame, which is the daily time frame. Okay, and then in the bottom part, we have the 55-minute time frame, 55 range time frame. That's edge, and then for reactive 21-21. Okay, and again, if you're not familiar with common, edge, and reactive, you need to go back to the YouTube channel and watch the 4 sessions that we have conducted on intraday trading. Let me show you this very quickly. So I know some of you are watching this recorded, or you jump into Forex without watching the other ones. So here below, get together sessions, okay? View the full playlist. So if you scroll down, you have starting here, April 7, intraday 1, 2, 3, and 4. Okay, so you need to watch those 4 sessions. Most of the examples are futures, but you get all the rules on how to do directional trading. And even though it's intraday, then the same rules will apply for Forex with the 240 and the 60, but also with the daily, weekly, and monthly. So next weekend, when we do sharpening, I will get into longer term trading, and I will get very advanced with the daily, the weekly, the monthly, and all of those things. Okay, so I will repeat that next weekend. But just keep that in mind, that all the rules that you have been learning that apply to intraday trading will apply. The only difference that will change is the time frames that we use. So now you will use the daily for the common, 55 and 55 for minute and range, 21 and 21 for minute and range for reactive. If you want to do weekly or monthly, same story. So if I open chart layout, Forex weekly, and by the way, these are the time frames that you will use for carry trades, okay? We'll talk about this next weekend, because we'll talk about the long term with the carry trades, and we'll do it with, we'll talk about ETFs, we'll talk about long term, we'll talk about carry trades. So next weekend will be long term stuff, okay? So notice what happens. On the top, I got 1 week. On the bottom, I got 144, and 144R, and then 55 and 55R, okay, which is exactly what I got here, 144, 144, 55, 55. You can use 240, 100, you can use 60, 10 if you're using a basic plan, okay? And then for the monthly, same story. So I'm gonna load a chart, I'm gonna load the monthly effects. And what we're gonna have now on the top is the monthly time frame, okay, with an average and the DMI. Okay, here's the average and the monthly time frame, M for monthly, and then in the bottom part we have 377 minutes, 377 R range, and then 144, 144, and again it's what you have here, 377, 377, 144, 144. So again, I'm just displaying it for you guys, so you can see it. Okay. Yes, Buna, we use tick charts in futures, okay, not in Forex, because you only get the ticks from your broker in Forex. There is no central exchange. So we use tick charts in futures, not in Forex. Coming back to this chart again, notice how here we are using tick charts. Okay? But that is futures. It is not spot Forex. Tick charts in spot Forex, they mean very little, because they only mean what your broker means. Okay? Good. Okay, So I think that as a kind of like a summary of many things that we have said today, I think that something that would be very healthy is to, before we go, plan on a trade. Okay, plan on a trade, so that way it gives you the opportunity to rephrase some of the things that I have said and put them in action together with using the forex markets, but also combined with the concepts. Okay, and this probably would serve as a great way to summarize and conclude today. Okay, and then of course during the trading days, we'll be now starting from now on, we'll be using a lot of more of forex. Okay, and we'll be planning on those trades as well. Okay, and through practice and getting together, all of these will sink in. Okay, so at the end of today, if you have additional questions on forex, you feel free to send questions to us and we will help you. Okay, but again, I think that if you watch the 4 sessions that I was mentioning earlier in our YouTube channel with the sharpening, and you rewatch today's session if needed, then forex trading should be clear, because really the only thing that changes, if you think about it, is going to be the terminology and the fact that forex is decentralized, and therefore there are 2 rules that I need to teach you on. Remember when I told you what happens when you buy or you place a stop, and also the difference of prices of brokers. So there are a few impacts and which are derived of the fact that forex is decentralized. Okay, but in the end, the way you trade is exactly the same as the methodology explained in intraday. So please go ahead and watch them if you haven't. Okay, and by the way, since I'm here, quick reminder, please right now click subscribe, click on the bell if you haven't, and also click on the thumbs up that you will have in as you are watching the YouTube session. Give us a thumbs up if you're happy with it. So anyway, so let's plan a trade. Okay, so let's plan a trade. I'm gonna use the euro, for example. So what do we have with the euro? So with the euro in the monthly time frame, we have an average located at 113.63, and if I was to look at our time-based time frame, we got nothing around 60. And if I was to look at the range chart, we got nothing around 60 either. Okay, so actually we do 42 to 90, so 60 is in between. So this one qualifies. Yes, it does. This one qualifies. Yep. So here we go. So let's go ahead and plan on this trade. So if we were to plan on this trade, you would first, so we are planning on a trade on the Euro USD using monthly as a common time frame. Okay, trend is down, so we want to be short. Okay, also strength is strong. Okay, so we are expecting for a nice move. Okay, so now that you know this, the second step is that was step 1, isn't it? So step 1, define what should you do? Should you do nothing? Should you go long? Should you go short? What's your side? So we decided to be on the short side. Number 2, set the target. So I'm going to activate UFOs. You will want to go to a larger common time frame, but unfortunately this is the monthly, so it's as large as it gets, so there is nothing else I could do. So what I'm going to do here is look at what is my next UFO, which is that one here, the one that is olive green 10905. So 10905 is going to be my final target. Okay, that's what we're shooting for. I got these from the monthly time frame, which is the common time frame, correct? So I'm gonna disable UFOs. We don't need UFOs there, it's too much information. Now what I'm gonna do is look for an entry short, which is located around 113.63, which is the average. Okay, so set entry, okay, which is a short entry. So my short entry is gonna be located at around 113.63, and I have here 113.42 to 113.90. Okay, 113.42 to 113.90. Okay, those two values, okay, have the 63 in between. In other words, that's gonna be my UFO. Okay, so 113.42 will be my entry. Notice how I am using 4 decimal places, even though on the chart I got 5. Okay, but in trading forex normally we use the 4th. There's no need to be that precise. So that will be our short entry. Okay, and now that we know our short entry, I am now also ready to place my stops. Okay, which is the methodology that we describe in those intraday sessions. Okay, so where are my stops going to be? Okay, they need to be on the white space above the red UFOs. Okay, and you will see how I'm going to have a little bit of a conflict here, because if I look at 90, okay, and I look at going above, let's call it 91. Okay, so what's the problem I get? Okay, what's the problem I get? Well, yeah, so yes, I didn't read this properly, guys. Earlier I was looking at 90 as the entry, but notice how, funnily enough, 40 to 6 is also here and 40 to 6 is also here. So the 377 range chart and the 377 minute chart, both, this is not that common, but it's happening today. So both got the UFOs in the same place. Okay, so anyway, so I haven't said anything. It's all good. Okay, so now remember I said there are 2 questions earlier. I said 2 key questions that I always need to ask myself. Okay, this, you would not need to do this if it was futures, but if it's forex, you have to ask yourself those questions. So are you buying or selling? Well, the final target is a buy, correct? Because you short, so you sell at 113.42, but you buy at 109.05. So that one is a buy, which means we're gonna have to do something about it. The stop should go above the white space, above the red UFO, which is 113.91. Okay, 113.91 is above the UFO, and that one is also a buy. The second thing that I was saying here earlier is, am I a buyer or a seller? Second question is it a stop? Okay, well, that one is a stop. Okay, so what do I do now that I know which of my orders are buy and which of my orders are stop? Well, here's the rule that we're gonna use. I told you earlier that I would need to add an extra rule. So here's the rule. Okay, add 2 pips to all buy orders. Why do we add 2 pips to all buy orders? To avoid not being filled. Remember, forex charts are bid, but when you buy from the ask, and the ask is higher. Okay, and earlier it was higher by 0.8, but this fluctuates during the day and it changes through brokers. So to make it very simple, I'm just gonna ask you to add 2 pips. So instead of 109.05, it's gonna be 109.07. That's gonna be your target. Okay, so this is gonna be your price. This is a very simple calculation that you don't need to do in futures, but you have to do it in forex. Short entry, we do nothing because it's sell. Sell means that the answer to am I buying is no. The answer to is it a stop is no. So there is nothing to do. Okay. Here again we got buy. So what am I gonna do? I'm gonna add 2 pips. But what else? It's also a buy stop. So what do you do? Well, we're gonna add 5 pips to all stops. Okay, and why? Because different brokers have different prices. Okay, different brokers have different prices, And even though our UFO here finishes at 97, 113.97, other brokers may have it 91.2 or 90 whatever. And sometimes you may have a bigger influence, a bigger difference than what you think. And to be on the safe side, we're gonna add 5. So therefore we're gonna add 2 plus 5 pips. That's a total of 7. So if I add 7, that's gonna bring it to 113.98. Okay? And 113.98 is happening right below 99. So in other words, 98 is on the white space between 97 and 99, so we are fine. But if 98, let's say 98 was to be 1400, right? And you were to be inside that red UFO, then we would need to move the stop up all the way to above 114.37.4, okay? Which in this case is not the case because it's not overlapping, okay? So it's good. So this would be the plan for the trade. We're gonna have a short entry located at 113.42. The final target will be 109.07, and our stop, in case we're wrong, is going to be above the entry at 113.98. That's the plan. Okay. Now, to be just a little more visual, normally the stop is above the entry, short entry is below. Okay, the stop is a protective stop. It's not a breakout stop. Okay. Then below we have a safety target, which I haven't calculated. I'll do it now. And then we have the final target. Okay. So protective stop, short entry, safety target, and final target. Okay. That's the plan. And where is the protective stop? Well, the protective stop is going to be located at 113.98. The short entry is going to be located at 113.42. So what is the risk of this trade? 98 minus 42. You are risking 56 pips. So we want the safety target to be located 56 pips below the entry. In other words, 113.42 minus 0.0056, that is 112.86. 112.86. And the final target will be 1.0907. Okay, so again, the whole size of the move from 113.42 to 109.07 is 435 pips. Okay, so risking 56 to catch 400, not bad. But what's the beauty on top of it? You are short the euro, long the US dollar, you are gonna get positive swaps. And if this trade, which is based on a monthly time frame, takes 4 months to get to your target, so in addition to the profits that you would make in this trade by collecting 435 pips, you would also collect interest rate in this particular case. Okay, so this is an example of a carry trade. Okay, that would be a valid carry trade, even though I'll re-explain this better next week. Okay, so let me take a look at your questions. Subhash, best time for intraday trades. Normally there are 3 times which are very important in Forex, which is the Tokyo Open, which is the London Open, which is the US Open. Of course, the US Open is the most important one. The second one is the London one. The London one is the most liquid, but the most movement normally is still US. And then Tokyo also gives a little bit of a boost, but normally the Asian session is not that quick. Okay. So those would be the best times. But to be honest, any time is good. Subhash, Buna. You cannot draw the 377 range on TradeStation. Please help. Yes, I already mentioned that, isn't it, Buna? So if you if you cannot do the 377, it's because you're using a basic plan. So it's either you upgrade TradingView to be you said TradeStation or TradingView? If it's TradingView, you either upgrade TradingView Got it. I didn't read your question correctly. So you're talking about range charts on TradeStation. Yes. I'm just going to be very simplistic here. I would not use range charts on TradeStation for this application. I would just stick to TradingView. In this particular case, it would give you a much better result. Okay. The way range charts are calculated in TradingView is more efficient. So yeah. So it's either you do futures with TradeStation and you do shares and ticks, or you do Forex with TradingView and you do minutes and range. Okay. But I would skip the range charts on a TradeStation. You can just use the minutes and that's it. It's basically almost the same. Okay. You'll miss a few trades, but that's it. Yeah, dear, you can do it, but it's not as intuitive and it has many parameters. So it's going to be a little too complex. Okay. Good. So anyway, so I believe I have one last thing to comment, and we will go home. We will conclude the session. Okay, guys? So it has to do with the size. Earlier we talked about mini lots, micro lots, and lots. Okay, and the reason why is because now you have a trade where potentially you have 400 plus pips of profit margin in exchange for a risk of 56. Okay, so it's nice, but how much money is that? Okay, so that I believe is a pretty key question for everybody, isn't it? So how much is that? So again, that depends on the size. If you take this trade with one lot compared to you take this trade with 10 lots, then the performance is going to be different. You're going to be 10 times different because your size is 10 times different, right? So let's go ahead and build a little table here very quickly so you get to understand a little better all those things. Okay, so for example, we talked about full lots. We talked about mini lots that we call minis. We talked about micro lots that we call micros, okay? So how much is a lot? 100,000. How much is a micro? 10,000. How much is a mini? A micro? 1,000. So a mini is 10,000, a micro is 1,000, okay? We know that from before. But now, there is something very important in Forex trading, which is what we call the pip value. In other words, if you're going to take a trade and the trade is going to lose for you 56 pips, that's interesting to know. But what I want to know is in dollars, how much is that? Or in euros, how much is that? Okay? And the answer is the pip value. So if a pip, let's do the math. If a pip is 0.0001, okay, and let's say the euro moves in your favor by 0.0001, and you had a position size of 100,000 euro, right? So what is the pip value? Very simple. It's 10. It's $10. Okay. What if it's a mini? It's 1. What if it's a micro? It's 10 cents. 10 times less, 10 times less. Okay. So this is important for you to keep in mind, because if you keep this in mind, you will now know how much that value is. Okay. So let's say that you took this trade. Okay. So in this example, let's assume you entered the trade with one full lot. So what will happen? Your pip value is 10, which means that your 56 pips multiplied 10, in this case $10, okay, $10 because it's euro US dollar, so it's quoted in dollars. So 56 times 10 equals $560. So this trade will be risking $560 for you, while in the profit side, if you were to collect those 400 pips, you will be profiting at a rate of 10. Same thing, same rate of 10, because it's the same pip value, because it's the same currency. And how much would that be? Well, that would be $4,000, isn't it? So that would be how you would know how much you're about to make, how much you're about to lose, and therefore how many lots or how many minis or how many micros do you need. Let's assume that instead of using one lot, you are using 3 mini lots or 3 minis. Well, if every mini pays you at a rate of 3, at a rate of 1, 3 minis will pay you at a rate of 3. So how much would your profit, would your loss be? 56 times 3, that would be $168. That would be your risk in exchange for 400 pips times 3. That would be $1,200 of profit. So everything, the relationships and everything is maintained, but it could be different depending on the currency pair, and certainly different depending on the size of the trade. Okay, so if you were to use a different currency which is not quoted in US dollars, right? Quoted in US dollars, the last 3 letters, but your account size was US dollars. So for example, what happens if you, so pip calculator, so we'll pick XM again. So what if you were trading the whatever, the Euro Canadian dollar? So you are trading the Euro CAD, right? Let's say you have account type is micro lots, okay? So let's say you are trading a small account with micro lots, and let's say you took 1 micro lot, okay? And your account is in US dollars. So you have an account with 5,000 US dollars. You are trading the Euro CAD. You are trading 1 micro lot. How much is the pip value? So you have a pip value of 0.007 in US dollars. Okay. Let's say you are doing the trade with 17 micro lots. So you have a pip value. By the way, 17 micro lots, it's 1.7 minis, right? So you would have a pip value of 126. So let's pretend that we trade that we had before. Instead of this being the euro, let's pretend it's the Euro CAD, right? If it was the Euro CAD and you had taken a trade with 17 micro lots, what would happen? You would have a risk of 56 pips times 126, and this would be $70.56. Okay. Same would happen to the profit. You will profit at a rate of 126. I just typed this in the wrong place. Here is better. Okay, so what would be your profit in this particular case? Okay, well, 400 times 126, that is 504. So now you will be risking $70.56 in order to make $504. And how did you know that? Because it's 126. Okay, now what if you go for the US dollar, for the euro US dollar? Okay, where the quote currency is the same currency that you have in your account. Okay, so if I do, for example, 1 lot, okay, 1 standard lot is going to be 10, as you're about to see. It's 10, right? Why? because 0.0001 times 100,000 is 10, okay, which is what we said before. Okay, so this table, okay, is valid for currencies traded with the USD in the quote, in the quote. Okay, for any other currency, you will need to use a pip calculator, okay, which is often built in the trading platforms, and then you can do the math. Okay, even though I chose to use this website because I think it's quite visual. Okay, so let me see what we have, because I believe that we're basically done with what I wanted to cover. So basically what we covered today is that trading Forex is basically the same thing as trading anything else. The only difference is that it's a decentralized market. It has its own terminology. We trade in pips. You have micros, minis, and full lots. You know, we need to add 2 pips for our buy orders, okay? And we need to add 5 pips for our stops. You know, those are rules that don't apply to other markets, but they apply to Forex. We talked about the time frames not to go below 15. You could go to 5, but only for the majors, even though it's not super recommended. We talked about the swaps, okay, which is unique to Forex, etc., etc. Okay, so anyway, reading the last questions here. Yes, David, very, very convenient to use TradingView with Oanda, because you can just come in here and in the bottom part where it says paper trading, you can, that's your trading panel, you can select another broker and you can pick Oanda. So if you have already an account with Oanda, click live or demo, whatever you have, okay, and you just continue, and then you will be able to then add your username and password, and from here, without having to go anywhere else, you can do all your execution, not only your analysis, but also your execution. So it's pretty cool. Okay, good. Yeah, Moshi, you can also have an MT4 platform with Oanda and many other brokers as well, and many of our community members, they are doing that. Okay, so in one computer screen, they do their analysis with TradingView and the UFOs, and with the other computer screen, they are using MT4 to do the placement of the orders. Okay, very, very common to do that as well. Subhash, thank you for educating us on Forex. Hope we will have adventure with this asset class. Forex is beautiful, Subhash. Beautiful, beautiful. But to be honest, futures is beautiful too, and options is also magnific. So, I mean, you know, if you love trading, you just love trading, and you're gonna enjoy Forex. You just need to understand the intricacies and the specifics so you can take advantage. And there are certain things that are really unique. For example, taking advantage of the swap rate. Okay, I mean, let's face it. If you were to do this trade, okay, let's do one last calculation for the day. Let's say you do this trade with 5 micro lots. Okay, with 5 micro lots, you're gonna be exposed to $5 per pip, correct? So $5 times 55, it's 280, correct? Let's be a little more precise now. So if your entry is 1342 and your target is 907, you are gonna make 435. So 435 times 5, that's 2,175. Okay. Now, because you have a safety target and you have a final target, okay, you will make this by 50%, right? Because you scale out. Okay, you scale out half of the position on the safety target, so you are left with half of the position. So this divided by 2 is gonna be 1,087.5. And for your safety target as well, here you're gonna make a profit, safety profit of 280, 50% of it will be 140. Well, that was easy math. Okay, so $140. So the total profit you're about to make in this trade, assuming that the plan will work according per plan, would be 140 plus 1087.5. So you are about to make a total profit of, okay, total profit is based on the directional movement of the euro 1,225, okay, with a risk of 280, you know, which I think the math speaks for itself. It's pretty cool. But that's not all. You are doing a carry trade, isn't it? So if we go back to the swap calculator and we are shorting 50. Okay, so shorting 50 micro lots. 50 micro lots is 5 mini lots, correct? So if we short 50 micro lots, this is gonna pay you actually that's the euro. So by shorting, you're gonna get paid 3.02 euros while you are in the trade. Sorry, 3.02 US dollars while you're in the trade. So really, what we don't know is how long the trade is gonna last. But given the fact that it's being planned in a monthly time frame, let's pretend the trade lasts 4 months. Okay, so in 4 months, how many days you have? Well, 365 divided by 12 times 4, that would be 121 days. 121 days where you will get paid at a rate of 3.02. You just got paid additional $366 on swap rates on top of your 1,227. Okay, so you would have a profit total of close to 1,600. Okay, so again, it's pretty cool. Okay, and now, you know, this calculation here, maybe I did a little too fast, and if that's the case, you can always rewatch the recording, but it kind of put many things on the table, things that we have discussed during the day, such as the size, the pip value, the swap rates, you know, etc., etc., etc. Anyway, yes, well, very appreciated, Al. Very, very glad to see you here in the session. And yeah, my pleasure as always, guys. Okay, so now we know a little more about Forex, and the way we will really learn Forex now is during our trading sessions. We will be planning on Forex trades, okay? And those Forex trades, as you guys execute them, you will be learning a lot about how Forex work as well, okay, guys? So anyway, guys, I will conclude the session now. It's been a pleasure to have you here for 2 hours and a half, okay? It's been a pretty intense session. Next weekend, we will get together again for sharpening purposes, and it will be about long-term trading. So we'll be talking about how to do long-term and the differences when you do long-term compared to short-term for all assets, including Forex, but also markets such as ETFs and even the futures. So we'll be talking about the long-term, okay, a little bit of everything. The long-term without options, okay, without options, okay. And another day we'll also add options because obviously it would not be possible to cover everything in 2 hours, okay? So anyway, have a good rest of the weekend. Super pleasure to be here. Again, as always, loving the interaction during the session. Also really, really loving all the emails that we receive from you guys. You know, sharing your stories and your successes and how everything is going. And, you know, in many, many cases, things are going quite well. So we are very happy. But this doesn't mean that if you have any issue, any trouble, it doesn't mean that you need to remain silent. Okay, guys? So if there's anything that is not going well on your side, make sure you speak up, send us an email, reach at tradewithufos.com. Okay, so reach at tradewithufos.com. And we can talk about it. We can talk about it via email, or we can even talk about it during the sessions. And if you want it to be anonymous, we'll keep it anonymous, okay? But we can certainly look at your cases and the things that are happening in your side to help you go to the next level, okay, guys? So anyway, you guys take care and talk soon. Bye bye everybody.